Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Thank you for tuning in to episode 52 of the show. This is the one-year anniversary show, and for it, we are giving away a copy of Joe Fairless's best ever apartment syndication book. He was a guest on the show. If you'd like to get a copy of the book, or enter to win a copy of the book, send an email to glenn@glennsutherland.com. In the subject line, say something like 1 year or book giveaway. And in the body of the email, just say where you subscribe to the podcast. Without ado, here's the episode. Thanks, everyone. Welcome to another episode of A Canadian Investing in the U.S. This week, my guest is Shawn Rea. Shawn, tell us a little bit about yourself.
Thanks for having me, Glenn. Appreciate it. So I started investing in real estate maybe about 6 years ago, and it blossomed from what I thought initially was just going to be an initial purchase of an asset to offset some of our expenses, because we had a growing family at the time. So we had built a new home, and I remember I had watched an episode of Income Property on HGTV, and it kind of like, kind of got my wheels spinning, and I said, I think I want to do that. I think I want to, buy a place and rent out a portion of the house to offset my mortgage, my property taxes, insurance, and kind of lower our living expenses, because it's hard to get by on day to day, and that ended up becoming something completely different. I went way off track, and now I'm, I guess, becoming a real estate investor. That's
awesome. So what I was originally drawn to you was when we were talking on Facebook, and I saw your messages, and maybe we'll talk about that one deal you had that you were talking about, and then we'll go into some strategies afterwards.
Yeah, so one of my latest deals that I picked up at the end of last year was what I would consider like a perfect BRRRR. Yeah. I know you've had other people on your podcast there and your channel that talk about BRRRRs. So most of your followers are probably familiar with what BRRRR strategy is. If they're not, it's basically buy, renovate, refinance, rent out, and repeat it. And you recycle your money. So whatever money you put in, you try and pull it back out as quickly as possible. So I was the latest property that I picked up, I actually got it off of MLS, and it ended up being way higher than what I wanted to pay for it. Initially, the asking price, and I went back and forth, negotiated with the seller. The initial offer that I had given them, they kind of just looked at it, laughed it off, and didn't even come back. It sat on the market because it needed a full reno. So it sat on the market for about 90 days, and the seller ended up coming back and said he's willing to negotiate. I was able to get that property for pretty much exactly what I wanted to buy it for, which was way under the asking price. Perfect. I knew it needed renovations, so I had estimated that it needed about $25,000 in renovations, and I got these numbers through my contractors. So I have a team of contractors here that are local to the Niagara region. Yep. Got them to do the estimates and everything. Went through with the renovations. We were actually able to do the full renovation in 30 days. Now I do work a 9-to-5 job, so I was going to my 9-to-5 job. I was going home, having dinner with the family, and then going straight to the house and managing the contractors and putting sweat equity into there every single night. But we managed to get it done in 30 days. We got it rented out. Our costs to own the property. So I ended up going back a little bit. I ended up doing what's called a Purchase Plus improvements on this property with Scotiabank. Yep. Okay, so I bought it, and the way the Purchase Plus works is you'll estimate a certain amount. So in this case, it was $25,000, and for your rental costs. And so spent the $25,000. I went back. They did another appraisal on the property, and I was able to recoup that $25,000 within 45 days after the appraisal. we had it tenanted within 30 days. So we had purchased on September 1st. October 1st, it was tenanted. And the way the numbers played out, I'm cash flowing on this property just under $1,600, and it's a 2-unit duplex.
Awesome. So what are the rents like each one?
So I have them all inclusive.
Yeah.
And I have $1,450 for a 3-bedroom. Yeah. And $1,250 for a 2-bedroom.
Pretty good.
And we have property taxes, insurance, mortgage, and utility costs at around $1,100.
Nice. So where is this property located? What city are you in?
This is actually in Fort Erie, Ontario. Yeah. So it's in the Niagara region. It's I would say the market itself is very low vacancy rate, and there isn't a huge amount of investors that are like putting offers on properties here. So it is, some of the properties do go pretty quick. This property specifically, I believe the reason it didn't go quickly, and I was able to take advantage of that, was because they had actually listed it quite high for the value considering how much renovations it needed. And that's why it sat on the market. So whether it was a real estate agent issue or not, I don't know. But, luckily I was able to go in and get it at the price that I wanted, which was quite a bit less than what they were asking.
Some of my deals just get screwed because I'm like, some people will pay way too much, and
Absolutely.
Maybe like Fort Erie is a great market for if you find something there. Maybe you just ruined your secret and you'll have some new competition. But no, that sounds awesome.
Yeah, you know what? I see that a lot actually with the different networking events that I go to, and just talking with other investors and stuff like that. And I hear that story a lot where, they you do the numbers, you analyze the property, and okay, depending what you're going for, whether you're going for some investors are going for capital appreciation, others are just going for cash flow. So some people just base it on the cap rates. And I think, I hear the story a lot, almost too often, where you have investors that are doing the analysis and they find that sweet spot for the number. And then you have somebody else come in and they pay more than what the property is really, really worth for a good, solid investment. So somebody's buying it what I would consider as a mediocre investment with mediocre cash flow.
Yeah.
It happens all the time.
Yeah, and I think those are going to be the people that struggle, especially if we see I don't think we're coming onto a recession at all, Canada or the U.S., but I think there will be some slight corrections in spots. And those people are going to have trouble when they've bought it, and especially if they don't cash flow. So
going back to the Jarvis BRRRR that we were just talking about, Jarvis is the street that I purchased it on. So this property actually is I guess the investors call it infinite return, right? So because it was a perfect BRRRR, I was able to refinance 100% of my money out, and that $1,600 in cash flow is actually an infinite return that's residual every month that I don't. So that's kind of the bread and butter of what I try to replicate in my investments.
And that's exactly the name of the game, because if you just keep buying properties and you're using all your cash and there's no recycling of it, you will run out of money. Like, it doesn't matter if you have $1 million, you're still going to hit the end. Like, you need a system of either pulling in investors.
Yep.
Or which would be, I would be going that way for multifamily. And if you're doing single family, in my opinion, you need to do a BRRRR, because you need to have a way of adding value to this property and refinancing the money back so that you get all or most of your money back so that you can continue to do this.
Yes, absolutely. The strategy would be the same. If you're doing your joint ventures with money partners, you want to get the money back for your partners as quickly as possible, because then they're going to be more likely to do another joint venture with you. But if you're working on your own with your own money, you want to get that money back as quickly as possible. Also, when you have properties that are cash flowing positive that well, those A lenders that have the best interest rates are going to be more likely to keep giving you mortgages. So, with Scotiabank, I think the limit's between like 10 and 15 mortgages. So, and then you can still go to other A lenders after that. I am looking at doing potentially, some joint ventures with people, because it is a way that you can kind of expand your portfolio a lot quicker, grow a lot quicker. I find right now the hardest part is not finding the money or the partners. It's actually finding those really good deals. That's the hardest part, because when you go down and you do the numbers, you'll have real estate agents that send you properties that are 10% cap rate or a lot of them are sending like between 8 to 10% cap rates as like great investments. I honestly don't even look at it if it's less than 10. So for me, it has to be 10 to 15%. I like to follow the 1% money rule, which, it's for people who don't know, it's like if the property's $500,000, then it should bring in $5,000 a month in rent. So it's like super simple analysis. If it doesn't meet that criteria, maybe don't even bother looking at it. If it does, then dig down a little deeper and see if it makes sense, if it's a good investment. So I did have somebody send me a property earlier this evening, a real estate agent, and they had said, hey, Shawn, this is a 12% cap rate. It's a 5-unit, something you're probably going to be interested in. And I went through and did the numbers on the spreadsheet, and there was actually mistakes in the numbers. And I went back, and then he recalculated. He's like, oh, sorry, it's only 7.9%. So not for you.
That is a great tip too that we should like actually deep dive into. Is I do the same thing. I have my own sheets, and whenever I get numbers from realtors or anyone, wholesalers, I move. I'll use their numbers to get a good idea if it's even something I'm worth digging into. But I move it into my own sheets, because then I can compare it from apples to apples to apples. Because sometimes there's really good wholesalers that will factor in vacancy rates, and they'll factor in all these extra things, and it makes their deal not as good as other ones when it's actually better. And you just need to get a good sheet, or even just email me. I'll give you my sheet, because mine's just borrowed from someone else too. I don't even know where I got it anymore. But put it in your own stuff, because that's otherwise you could have missed that, right? You could have been stuck buying something that wasn't it wasn't what you thought it was, right?
Absolutely. That it's very important to know your numbers, and and include all those numbers, like you said, include the mortgage payments or the line of credit interest payments. But you got to include everything and know what the number is. And for myself personally, I purchase on cash flow. So when I purchase it, I should know exactly what my expected return is going to be on positive cash flow. And if it doesn't meet, some people have like $200 per unit on their cash flow. I hear that number $250. I hear that number thrown around a lot. But there's deals that you can make that are a lot better than $200 and $250 cash flow. So
you mentioned possibly using a joint venture for the future.
Yes.
Why? Because I dabble both ways. I in my mind, which way is the better way? So why do the joint venture over using private money?
Well, I think that at some point you will max yourself out. So at some point you're going to run out of A lenders.
Well, I'm not talking A lenders. I'm talking even just going to my local REA, paying them, 7 to 10% for some money, but then I don't have to split profits with anybody. I get the whole thing, right? Especially if I'm doing a BRRRR, it's an infinite return. I can borrow the money and return it. And so I always do I want to do JVs and get more people in? Which it's good because I want to grow, and but it's also do I just keep being selfish and keep it all in my name, but I can keep growing too and don't have to pay as many people, right? It's more...
Yes.
I don't know.
I understand both of them. Both perspectives make sense. I think that, from one perspective, if you're working with a team of people, so even myself, just, not doing joint ventures, you see multiple people that have multiple joint ventures going on and they're growing significantly. Not doing that, I still have a team of people that help me with everything, right? So you have your real estate agent, you have your lawyer, you have your mortgage broker, you have your other investor friends and team that help you out with deals. And I think growing and working as a team is going to make your success come to fruition a lot faster than working on your own. So that would be the only reason that I would say absolutely do that, because when you have more people working together and you have a bigger team, it's going to be a lot faster. It's like 10x yourself.
Yeah.
What
did I say? Your network's your net worth.
Yes. Yeah. Absolutely. And it is a lot harder to work on your own. I kind of that it was really tough for me to get to the point where I've purchased multiple multifamily properties, and it was a grind. I didn't have anybody to really show me the ropes or guide me where I had to go. I had to do the education all on my own and really dig deep and find out and figure out my own path to get there. So if anything, I think that even doing joint ventures is helping other people with their financial IQ, and real estate it's a generational wealth if you're buying and holding.
Yep, totally agree. Before we leave, is there anything you can tell us about Fort Erie?
Yeah, so right now there's about 3 developments that are going on. Now the town is smaller; it's 30,000 people. I have investments not only in Fort Erie, but they're all in the Niagara region. So there's other towns and cities. There's St. Catharines, Niagara Falls, Port Colborne, Welland, and Fort Erie. That's the main hub where everything, all the investments are. And that and the surrounding areas have all grown in value tremendously because it was a stale market. The prices hadn't risen. And once you saw Hamilton and that area grow, all those prices started coming, all those prices and the influx of people started coming. And I think that the Niagara region has kind of just balanced out on pricing. So there's still really good deals to find, but you have to be patient. And right now, I wouldn't say it's easy to find a good deal because you really got to be persistent. You got to, have the fortitude to be looking every single day, and trying to find the best deals that are on the market. But the market rents are great. So market rents are the same as St. Catharines, which has a much larger population. So you can get for a 2-bedroom, you're going to get 1,200 utilities. For a 3-bedroom, you can get 1,500 plus utilities. If you do the math and you got properties that are in the $200,000 to $300,000 range, it makes sense.
Awesome. If someone wanted to get a hold of you, where would be the best way to do it?
You can find me on any social media under Shawn Rea. It's SHAWN, last name REA. I'm on Facebook, Instagram. I also have a website. It's reaig.com. And I have another Instagram and Facebook account under Rea Investment Group. If anybody does want to reach out to me, feel free to. I'm honestly really happy to just talk about real estate and help people, because I know the struggle that I had just to get my first and second and move to third and then double my portfolio.
Thank you so much for coming on the show. I think this will be a great episode.
Yeah, thanks for having me. I appreciate it. And hopefully we can meet up. I know I missed you at the meetup in was it in Niagara there?
I was in St. Catharines on Thursday. Yeah.
Yeah, I actually meant to make it, and I didn't get to make it, but hopefully we can meet at one of the other real estate meetups soon.
Yeah, definitely. I think I'll be at that same meetup next Thursday. I think Maria was messaging me again today, wanting me to go down there for some other panel, but I don't know what it's for.
Okay.
I haven't got any details, but I'll likely be down there. And then I know this is really far from you, but I'll be speaking at Rea in March. And
is that Windsor?
No, London.
London, yeah. The 26th, right? Or the 28th?
I think
something like that.
I think it's the 20th in London, and I think it's the last Thursday of the month in St. Catharines.
Okay, awesome.
Cool.
We'll keep in touch.
Nice to meet you. All right, see ya.
See ya. Bye. See ya.